everybody, Chris here from projectoption.com, and welcome to the third installment of the ultimate guide on trading vertical spreads. In this video, we're going to cover the bear call spread, which is the second of the four vertical spread strategies that we're going to discuss in this series. So let's get right to it. Now, the bear call spread is, you guessed it, a bearish call spread strategy, and here is how you set it up. So first you're going to sell a call option, and then you're going to buy another call option at a higher strike price in the same expiration cycle and with the same quantity. So if you've watched the bull call spread video, you'll notice that this is the exact opposite, and this is because when you're trading a bull call spread, you're buying a call spread, but the bear call spread means you're selling a call spread. So you're going to sell a call option and buy another call option at a higher strike price in the same expiration. Now, the bear call spread makes money if the stock price remains below the strategy's break-even price as time passes. Now, we'll get to this in a minute, but the break-even price of a bear call spread is the short call strike price plus the premium received. Now, when would you sell a call spread? Well, traders sell call spreads when they believe a stock's price will not increase substantially in the near future. Now, this is because when you sell a call spread, you want the stock price to remain below your short call strike price as time passes, but the stock price can actually increase a little bit against you, and it's still possible to make money. So when you sell a call spread, the only thing you do not want to happen is a substantial increase in the price of the shares. Now, to fully understand the strategy, let's go right into a real example using real option data. So the stock price at the time of entry for this particular bear call spread is $141.46. Now, for this particular call spread example, we're going to sell the 142 call for $1.93, and then we're going to buy the 145 call for 87 cents. Now, both options are in the expiration cycle that is 32 days away. So we're selling the 142 call and buying the 145 call in the same expiration cycle. And as we can see, both of these call options are out of the money. Now, when you sell a call spread, or any option spread for that matter, you are going to collect premium. So the premium we're going to collect in this example is what we received for selling the 142 call less what we paid out for buying the 145 call. So since we received $1.93 for selling the 142 call, and we paid out 87 cents to buy the 145 call, the premium we're going to receive for selling this call spread is $1.06. Now, the break-even price for this particular call spread is going to be the short call strike price of $142 plus the $1.06 that we received for selling the spread. So therefore, the break-even in this case is $143.06. Now, the maximum profit potential is going to be the premium we received times 100, since the standard option contract multiplier is $100. So since we collected $1.06 for this spread, the most we can make on the trade is $106. Now, the maximum loss potential for a bear call spread is the width of the strikes minus the premium received times 100. So in this case, we have a $3 spread width, so we're selling the 142 call and buying the call option with strike price that is $3 higher, which is the 145 call. Now, when you take $3 and subtract $1.06, that means we can lose $1.94 per spread, or $194 per spread in actual profit and loss terms. Alright, so let's go ahead and take a look at the expiration payoff diagram for this trade. Now let's start with the maximum profit zone for this call spread. So when you sell a call spread, the maximum profit zone is at or below the strike price of the call that you sell. So in this case, we sold the 142 call and we purchased the 145 call. So in this case, the maximum profit zone is at or below $142 at expiration. Now, if the stock price is below $142 at expiration, both the 142 and 145 call will expire worthless, which means that short 142-145 call spread is also going to be worthless. Now that means we can make $1.06 of profit per spread, since the spread was initially sold for $1.06 but expired worthless. Now the break-even price for a bear call spread is the short call strike price plus the premium received for selling the spread. So in this case, we sold the 142 call and we sold the 142-145 call spread for $1.06. So 142 plus $1.06 comes out to $143.06. So that is our break-even price. So ideally, you want the stock price to remain below the break-even price as time passes. Now, why is $143.06 the break-even price? And the answer is that if the stock price is right at $143.06 at expiration, that 142 call will have $1.06 of intrinsic value, and the 145 call will be out of the money and will therefore have $0 of intrinsic value, which means the 145 call will expire worthless. So since that 142 call is worth $1.06 and the 145 call is worthless, the net spread value in that case would be $1.06. Now, if you sell a call spread for $1.06 and it expires worth $1.06, then you don't make or lose any money. Last but not least, the maximum loss potential occurs if the stock price is at or above $145 at expiration. And that's because we purchased the 145 call, so that is the point of maximum loss. So if the stock price is at $145 or $1 million at expiration, it doesn't matter. The short 142-145 call spread will be worth $3. Now, if you sell an option spread for $1.06 and its price rises to $3, then you'll have a loss of $1.94 per spread, which in actual profit and loss terms is $194 in losses per spread. So now that we've talked about the expiration payoff diagram, let's go ahead and actually see how this trade performed as the stock price was changing over time. So on the right hand side here, we're looking at a chart of the stock price and the price of the spread over time. So on the top part of this graph, we see the changes in the stock price relative to our call strikes. And in the bottom part of the graph, we can see the price fluctuations of this short call spread. So first and foremost, let's focus on the period between 32 and 17 days to expiration. So as we can see, the stock price rallies and nearly touches the long call's strike price. Now, if you sell a call spread and the stock price shoots upwards, that's going to generate losses for you because that call spread is going to rise in value. Now, since you sell a call spread, you want its price to decrease, which happens as the stock price decreases. Now, during that first period, we can see that the stock price increases and therefore the price of the spread increases, which means as a seller of that call spread, we have losses. Fortunately, the stock price did not stay that high for very long. So between 17 days and 0 days to expiration, the stock price headed lower and closed at $142.26 at expiration. Now that means at expiration, the short 142 call is 26 cents in the money and is therefore worth 26 cents. Now that 145 call is actually worthless at expiration, which means it is worth $0. And since that 142 call is worth 26 cents and the 145 call is worthless, the spread value at expiration is 26 cents. Now, since we initially sold the spread for $1.06 and it expired worth 26 cents, we make 80 cents of profit or $80 in profit per short call spread. Well, that wraps up the video on the bear call spread. So to quickly recap, a bear call spread is a bearish vertical spread constructed with call options. Now you're going to sell a call option and buy another call option at a higher strike price in the same expiration cycle. Now, as we've just seen in the previous example, right after you sell a call spread, the ideal thing to happen is that the stock price heads lower because that spread will lose value, which will generate profits for you as the seller of that spread. However, the strategy can still profit as long as the stock price remains below the break-even price as time passes. Alright, so if you've been following along from the beginning of this video series, you are now through the two call vertical spread strategies, and in the next video we're going to get started by looking at the bear put spread strategy, which is the first of the two put vertical spreads that you'll learn in this series. I'll see you there.